Hi, this is Dan Collins, editor-in-chief of Futures Magazine for Traders Exclusive. And this morning, live from the floor of the Chicago Board of Trade, I want to talk to you about commodity markets. Yesterday, a story came out in Bloomberg stating that ag-based ETFs have grown exponentially in the first quarter of this year, which is kind of interesting because what we've noticed at Futures is that while it's been a difficult 3-year period for commodity trading advisors, diversified trend followers, the managers who've done very well have been the ag-centered managers. Their performance has been very strong. And one thing that kind of distinguishes these managers from the larger universe of CTAs and trend followers is they are discretionary. They trade the ag complex, maybe a couple softs, or the ag and the livestock markets, and they do it from a fundamental discretionary basis. This is different than the larger universe of diversified managers who trade on a systematic basis. One of the reasons it seems that they've done better is because they are fundamental. They're a little bit more nimble. They can select the managers. They can select the markets. They know when they want to get in and when they get out. It's not dependent on a strategy telling them when to come in and come out. Now, we've known from talking with experts over the last couple of years that the biggest problem for CTAs has been the risk-on, risk-off nature of markets. Currencies affect commodities very strongly. So no manager can be an expert on 48 markets. So if they're trading that many, they usually do it from a systematic standpoint. The people who are fundamental and trade because they're experts on specific markets, of corn, soybeans, or livestock, are a little bit more nimble. They can get in and out, and they've done better. I mentioned the Bloomberg story yesterday because it's interesting. Those managers or those investments that people want to gain access to ag markets, they've done well over the last couple of years, but they've been very highly correlated with equity markets. So they're not delivering what they're supposed to be delivering. So what we see the growth is allocations to actively managed commodity-specific programs. It's a good investment. It's growing right now because we're going into the, in the beginning of May into the growing season, so it's going to be more active. And it's one added diversification because you put that next to a systematic manager, even if you're trading some of the same markets, they're not very correlated because they're trading on different drivers. So when you look at your, things to invest in, look at actively managed commodity-specific managers. They're diversified from equities. They're diversified from the vast CTA universe that is usually systematic. And as we're, 5 years into a bull equity market, it's more important than ever to have some diversification, to have some return stream that's not correlated with equity markets. So in our upcoming June issue, we'll be talking about the ag markets. We'll be talking to some managers who are specific, actively managed ag traders. So make sure to look out for it. This has been Dan Collins, editor-in-chief of Futures Magazine. See you next time.